Retail commercial sector on road to recovery. New growth is an early sign of a rebounding commercial real estate market. Institutional investors are driving the resurgence in the retail commercial property sector, as they try to increase core assets in major centers of the United States. This resurgence has come more as a trickle of new activity, rather than a flood, but the new growth is an early sign of a rebounding commercial real estate market. Owners of distressed retail properties offer steep discounts to attract investment from potential buyers, and this has helped improve sales figures in commercial real estate transactions. According to CoStar Group, major markets such as Houston, Tampa, South Florida, Long Island, Boston, Detroit, Philadelphia, Los Angeles, Denver and Phoenix all reported substantial increases in retail property sales in the second quarter of 2010. Distressed property transactions continue to rise, and account for as many as 1 in 5 sales. Shopping centers hit hard. Shopping centers have been one of the hardest hit areas of most commercial portfolios throughout the recession. With decreased spending, many retail tenants were not able to weather the financial storm. The trickle-down effect meant that retail centers suffered higher vacancy rates, reduced rental incomes, and higher tenant default rates. This has resulted in an increased number of retail foreclosures, increasing the number of available retail units. This increase has resulted in heavy discounts for retail property investors. The majority of transactions taking place continue to be commercial properties with high occupancy rates. Fewer buyers seem willing to take on tenancy risks, often associated with foreclosure sales. Retail malls and strip plazas with higher vacancy rates and lower quality tenants are offering steep discounts in an effort to attract investors. For example, this past year the purchase of a 1.4 million square foot Cincinnati retail shopping center sold for an economical $10.5 million, or $7.50 per square foot. The property was assessed at closer to $70 million as early as 2002. It's just one example of the discounts being assessed to distressed commercial sales. High vacancy rates. High vacancy rates have caused these distressed properties to fall into receivership. Potential investors must have a plan to decrease the vacancy rates and increase the revenue of the failing retail spaces. The ability to improve occupancy rates and secure high-quality tenants will separate successful investors from the rest of the pack. If the property owners are successful and increase vacancy rates, then they stand to make a substantial gain on their initial investment. Sales expected to increase. Demand for high potential distressed properties should continue to increase, as financial institutions make credit available to investors. Investors will seek out the deep discounts being offered on distressed sales, commercial or otherwise, as long as cash and credit for the purchases are readily available. This should not only increase sales activity, creating increased competition and firmer prices, but it should also increase confidence in the commercial real estate marketplace. Thanks for listening. Find more tips and training on our YouTube channel at bettergrouprealestate.com.